Chelsea, who have released their accounts for Kaveh Solokol, is alongside me. Doesn't make for great reading, does it?
No, Chelsea have made the biggest pre-tax loss in Premier League history. In their accounts for 2024-25, their pre-tax loss is £262 million. The previous highest pre-tax loss in Premier League history was back in 2011, when Manchester City lost £197 million. Now, Chelsea have filed their accounts with Companies House. These are accounts which are for the year ending the 30th of June 2025, so last summer. And they have published some details from those accounts on their website. We haven't seen the full accounts yet. Now, this is for a period during which, at the end of the season, Chelsea finished fourth. They also won the Conference League, and it partially covers the period in which they won the Club World Cup last summer as well. Their revenue for the year was £490 million. That is the second highest revenue Chelsea have ever had. The reason it went up to £490 million is because they finished fourth in the Premier League. They would have got more money from the Premier League. They won the Europa Conference, and they would have been able to bank some of the money that they earned from the Club World Cup, which was, I think, in total around £87 million. Match day income for them was about £86 million. Now, that is not as much as some other big clubs, because obviously their stadium is quite old. They don't have a new stadium like the Emirates or the Tottenham Stadium, and it's not anywhere near the kind of money that Manchester United make from Old Trafford on match days. They also say that they did make profits of £58 million from player sales, and looking ahead in their next set of accounts, they expect revenue to go up from £490 million to around £700 million.
Is that largely because they're back in the Champions League?
Yeah, because they're back in the Champions League and they won the Club World Cup as well. If they do post revenues of £700 million, that would put them up around the kind of ballpark figures of revenue we see from the biggest clubs in England, like Liverpool, Manchester United, Manchester City. That is what they expect to be posting in their next set of accounts next year.
Even though that might well be the case and that revenue will go up, there will be a lot of football fans watching saying, well, surely Chelsea can't go on spending money after money after money on players as they have done under the owners come next summer if they're posting a loss like that.
Yeah, obviously Chelsea spent a lot of money on players. They also, I think, historically are number one when it comes to raising revenue from selling players as well. We've also had this afternoon some figures from the Football Association. Every year they publish exactly how much each club is spending on agents. And we've had the figures from the FA. Chelsea in the period, £7 million on agents, Fulham £11 million, and Brentford £12 million.
It is amazing, isn't it, though, that they're so far above what you would say all their peers are, that most of the other bigger clubs are in the 30s.
Yeah, I mean, obviously it's an extraordinary figure, and the other extraordinary figure is if you add up all the money that Premier League clubs are spending on agents in a 12-month period, it's almost £500 million. I think it comes to £460 million spent on agents in 12 months.
Chelsea's record losses, rising revenues, and a path back to stability. How the Blues turned a £262.4 million deficit into a future of opportunity. In a season where silverware and headlines collided, Chelsea's 2024/25 accounts made for uneasy reading and fascinating analysis. The Blues reported a pre-tax loss of £262.4 million for the year, a staggering figure that sets a Premier League record and will inevitably focus attention on both the club's stewardship and the wider economics of elite football. Yet, buried beside that alarming number are important countervailing facts. Revenues grew to £490.9 million, and the club points to significant income expected in the next accounting period, thanks to triumphs on the pitch, notably the Club World Cup, and a raft of lucrative player sales during the summer transfer window. Losses of this magnitude can feel terminal on first glance, but a deeper look shows Chelsea in the middle of a dramatic adjustment. What appears to be a story of decline is equally one of investment, transformation, and, perhaps most importantly, the financial realities of modern football, where sporting ambition, global branding, and a volatile transfer market collide. This long-form exploration unpacks what the numbers mean, why they happened, how Chelsea can and should respond, and what the club's future might look like as it tries to convert recent on-field success and renewed commercial momentum into sustainable financial health. The headlines: the £262.4 million loss and what it represents. At face value, a pre-tax loss of £262.4 million is a headline-grabbing statistic that cries out for explanation. Such a figure is the result of multiple, sometimes unrelated drivers coming together, and it is important to separate one-off items from structural factors. Key drivers behind the loss: exceptional player trading results in prior years can create recognition timing issues. Big sales and purchases around accounting cutoffs can push profits and losses forward or backward between years. Heavy investment in squad rebuilding. Large transfer fees and rising wage bills often depress short-term profitability in the pursuit of long-term sporting gain. Non-recurring costs, severance payments, agent fees, consultancy costs, legal settlements, or restructuring charges can all swell a single year's loss. Depreciation and amortization. Capitalizing transfer fees and then amortizing them across contracts produces big annual lines that do not reflect immediate cash flows but impact reported profits. Interest and financing costs. The cost of servicing debt or loan facilities, particularly where leverage has been used to support large transactions or investments. Important context: Premier League clubs operate in a commercial ecosystem where breaking even each year is uncommon during periods of heavy investment. Many clubs run losses deliberately when chasing sporting success they believe will unlock greater future returns in broadcasting, sponsorship, commercial expansion, and prize money. What makes Chelsea's number eye-watering is not only its size, but that it arrived amid growing revenues and on the back of recent sporting triumphs, implying the club spent ahead of its income growth curve. Revenue growth: £490.9 million, and why it matters. While the loss dominated headlines, Chelsea's revenue performance is a positive foundation to build on. Revenues of £490.9 million represent growth in three core streams: matchday, broadcasting, and commercial, with player trading sometimes reported separately, depending on accounting treatment. Why revenue growth is promising: commercial strength. Increasing sponsorships, global partnerships, and merchandise sales are sustainable, recurring income sources. Chelsea's global fan base and attractive brand, aided by high-profile signings and silverware, are valuable when monetized effectively. Broadcast income. On-field success usually raises the club's profile in domestic and international competitions, which can in turn boost broadcast income, especially through European success or deep domestic cup runs. Matchday recovery. Post-pandemic stadium attendances and enhanced hospitality offerings contribute meaningful growth. Stamford Bridge remains a premium matchday asset. Transfer-related future inflows. The club's reported expectation of significant incoming cash from player sales implies an active and lucrative market for Chelsea's assets, which will materially affect soon-to-be-released accounts. Revenue growth matters because it provides the means to pay down debt, reinvest in the squad and infrastructure, and stabilize operations. The challenge is aligning cost structures with these revenue streams, so growth is not eaten away by inflated wages, sustained interest payments, or repeated one-off charges. The Club World Cup win and on-field success, tangible and intangible returns. Winning the Club World Cup is more than a single trophy. For modern clubs, it's a brand-building event that has measurable financial consequences. Tangible returns, prize money and matchday receipts from the competition itself. Short-term spikes in merchandise sales, particularly club-branded tournament kits and memorabilia. Media exposure and international broadcast fees that translate into higher sponsor value. Intangible returns, brand elevation in key growth markets, Asia, North America, and the Middle East, which helps secure larger, more valuable commercial deals. Increased appeal to prospective signings, who often prefer clubs competing and winning internationally. A narrative of success that helps the club's negotiating position with global partners and broadcasters. For Chelsea, the Club World Cup triumph fits into a broader effort to restore the club's international gravitas after a turbulent period. If properly leveraged, this success will underpin the commercial growth they reported and the further deals the club expects in the coming accounting period. The transfer market. Why sales and purchases distort the figures. Chelsea's summer transfer activity, both incoming and outgoing, is central to the coming financial picture. The club's comment that bumper transfer market sales will boost next period income suggests a large sell-on event or multiple high-value departures which impact reported profit and cash in complex ways. How transfers affect accounts. Profit and loss. The sale of players can create substantial profit on disposal if the sale price exceeds the player's net book value, original cost minus accumulated amortization. Large sales after a period of significant spending can dramatically restore short-term profitability. Cash flow versus profit. Player sales provide immediate cash, useful to pay down debt and cover operating shortfalls. However, purchases create amortization charges spread over contract lengths. This depresses future profitability, but not necessarily immediate cash outflows if structured as installments. Market volatility. Transfer fees are subject to market demand. A summer that produces bumper sales can correct a year's losses substantially. The next financial report may show a swing towards profit if disposals are significant and replacement purchases are moderate. Ownership, strategy, and governance. Who's steering the ship? Financial outcomes are only as sustainable as the club's governance and ownership strategy. Post-2022 ownership changes at Chelsea have brought new expectations about returns, competitiveness, and long-term strategy. Key governance considerations. Investment horizon. Is the owner seeking rapid sporting success regardless of short-term losses, or is there a push for financial prudence and sustainability? Board structure and financial oversight. Are there robust controls to prevent runaway wage growth and ensure capital allocation is efficient? Sporting director and recruitment strategy. A clear and consistent approach to player recruitment reduces expensive mistakes in the transfer market and guards against losing money on ill-fitting signings. Transparency and stakeholder relations. Clear communication with fans, regulators, and commercial partners builds trust when losses are reported. If ownership balances ambition with fiscal discipline, the club can convert current sporting momentum into sustainable business performance. Conversely, if losses persist without a clear return plan, regulatory and market pressures will mount. Wages and amortization and operational costs, the structural issues. Wages and amortization make up the largest recurring cost base for elite clubs. Chelsea's wage bill has often been among the Premier League's highest, reflecting an investment in top talent. Structural levers the club needs to manage. Wage-to-revenue ratio. Keeping this metric under control is key. Historically, sustainable clubs target a ratio closer to 60 to 70%, while extremes above that suggest vulnerability. Contract management. Shorter contracts reduce amortization periods but risk losing players for less. Longer contracts increase amortization but spread cost. Smart use of incentives, performance-based bonuses, and sell-on clauses can align costs with outcomes. Youth development. Promoting academy talents reduces